Clicking, Canada and the rest of the world may be entering into a new era of higher interest rates. This according to a speech given by Deputy Governor of the Bank of Canada, Paul Beaudry. The speech given by Beaudry was the first appearance of a bank official since the Bank of Canada surprised markets on Wednesday, raising interest rates by 25 basis points and reversing its 4-month-long pause. And while the speech did go over some of the main points that had been discussed in the bank's policy statement, that the bank raised rates due to a hotter than anticipated GDP and resurgent inflation, the Deputy Governor also went over where the bank sees the interest rate environment going in the future, and, if you take his words at face value, could represent a major shift from the low interest rate environment that we've known for the past 25 years.
The is that?
So what I want to do today is go over the Deputy Governor's speech, take a look at his comments on the future of Canada's interest rate environment and why we could be seeing persistently higher rates in the future, and then discuss what to look for next. Speaking of next, we do have a big couple of weeks coming up with the CREA set to release Canada's national real estate data for the month of May next week, and of course we have Canada's inflation rate coming out in a couple of weeks from now. We'll obviously have an update out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this speech. Onto the speech. As mentioned, the Deputy Governor went over the bank's rationale for increasing interest rates at its past announcement, which we've talked about in another video. But he also mentioned that the bank understands that the rate hikes are indeed painful, but they aren't as painful as run-of-rate inflation would be.
Now, really want to kind of stress here that we understand that, raising rates are hard on a lot of Canadians, and this is kind of something we take very seriously. At the same time, inflation is also hard on a lot of Canadians.
What do you think?
And we've talked about this before on this channel. Inflation is a currency killer, and absent a financial crisis, the bank is going to be laser focused on getting that inflation rate back down to a more manageable level. And after discussing the bank's most recent rate hike, Beaudry moved on to a chart looking at the downward trajectory of interest rates over the past 25 years.
Do I have to open anything or kind of turn something on?
We're in trouble.
Beaudry did eventually get the chart up, a chart showing that since 1994, we've seen a sustained downward trajectory of interest rates, moving from over 9% all the way down to near zero and then basically zero 25 years later. And there are three major reasons for the downward trajectory of interest rates over the past 25 years. Reasons, Beaudry says, which may be changing. First, there was a savings glut over the last 25 years, led in large part by the baby boomers, who saved far more than they spent.
When you're younger, you're kind of more boring and trying to get things going, and as things kind of get older, you have to start thinking about retirement. You start kind of trying to accumulate for retirement, getting closer and closer to retirement. That creates, so as the baby boom was kind of going through the system, it was increasing this savings rate.
So you had a lot of money leaving the economy, not swirling around in the economy pushing up prices. Baby boomers saved, and that wasn't money that was going towards goods and services.
I'd like to try that someday.
Second, we had the integration of China into the global economy.
Now, China is an economy that tends to save a lot. And this is true of lots of East Asian economies. They integrated, that was a lot of boost to savings. It kind of brought into the world economy a lot of savings because there was a lot of savings in those countries.
So Beaudry is saying that because the East Asian economies saved more than they spent, we didn't have as much pressure on global inflation. There wasn't as much demand in the system, and there was also a lot of money leaving the system. With that said, I think what the Deputy Governor wanted to say is that with China integrated into the global economy, we were also able to take advantage of their lower cost of production, moving manufacturing offshore, and killing jobs, which put downward pressure on prices. But I don't think that's something the Bank of Canada is going to brag about.
Probably a good idea.
Third, while we had a glut of savings, we didn't see a lot of that savings go into investment. Had that savings gone to investment, had that savings moved into the market, we would have seen higher inflation.
So during that period, actually investment hasn't been especially strong. This is not only in Canada, it's across all the advanced economies. It wasn't a period of very strong kind of growth.
So Beaudry is saying is that over the past 25 years, we had a savings glut on the part of the baby boomers. And with that money not swirling around in the economy, with that money being saved and available to be lent out, combined with China's integration into the global economy and a lack of investment into the production of goods, these three factors all work to keep inflation low. Now, in addition to these factors, Beaudry did neglect to mention the trillions of dollars that have been printed by the U.S. Federal Reserve as it bought up government bonds, injecting money into the market, which kept interest rates artificially low as well. When money is easily available, when it's been printed, the cost of that money goes down.
I forget things sometimes.
But I digress. Beaudry says those three dynamics that kept interest rates low for the past 25 years, may indeed be changing.
There's much more chance that if it's not there, it'll be higher than that than lower than what it was.
First, demographic. Those baby boomers are retiring. They're no longer saving. They're no longer taking money out of the economy. In fact, they're spending.
Baby boom went through this whole period kind of saving and saving and saving. Well, now a lot of that baby boom is either retired or retiring, and we'll get into a period where it stops saving and actually starts spending, okay? And so that's the aspect that isn't that same source of savings that we had before.
So those savings over the past 25 years that have been pulled out of the economy are no longer going to be available to be lent out. In fact, those savings are going to be entering into the economy, which will put upward pressure on prices as demand increases. Second, much the same is happening in China.
In China, because of the one-child policy, it's also a country that's actually aging quite quickly, and we have the same type of thing. There doesn't seem to be a country that's, the same type of thing that'll be integrating the financial market in the same way that China integrated with high savings that would be pushing that down.
And this line of thinking made the headlines at the beginning of 2023. When news broke that China's population was shrinking, and with China's population decreasing, there will be less workers available to produce those low-cost goods, which will put upward pressure on inflation and upward pressure on interest rates. Now, Beaudry isn't mentioning the rising geopolitical tensions between the United States and China and the reshoring movement stemming therefrom, but regardless, the Bank of Canada is predicting that China will no longer be the inflation anchor that it has been over the past 25 years. And finally, Beaudry says that a lot of investment is expected to be entering into the economy as a result of the climate transition.
Investment's really hard to predict, but we have a huge kind of climate transition to put. If things kind of work out, we'll need a lot of investment to get that through. Those are the type of things that might create more demand for capital at the same time. And as we hear a lot, there's artificial intelligence is really kind of coming up with lots of new things right now. That might also create a whole bunch of opportunities and new investments.
As demand for investment grows, as demand for this money grows, so too will the cost of money. Interest rates go up. So, in this speech, the Bank of Canada is saying that the period of ultra-low interest rates that we've seen over the past 25 years may be coming to an end. As baby boomers retire, as we can't depend on China as much as we did before, and as demand for investment grows, as demand for borrowed money grows, interest rates will have to go up. But I think the real takeaway of this speech, regardless on whether or not you agree with it, is that the speech was given in the first place. If the bank is taking the position that structural factors will be pushing up the rate of inflation higher than we've seen over the past 25 years, then is this a precursor for changing the target rate from the current 2%? As of 2 weeks ago, we're already seeing news stories about murmuring at the Fed in changing the inflation target. Or is this just job owning, forward guidance, kind of the inverse of what we saw from the Bank of Canada when they said that interest rates would remain low until 2023? Is the Bank of Canada just trying to get Canadians to slow down spending by saying things are going to get worse, in the same manner that they try to get Canadians to continue to spend by saying rates would be low until 2023? Or, a third option, the Bank of Canada governor could be signaling that the central banks realize that they've printed too much and now their currencies are at risk, and as such, they will no longer be able to artificially suppress the cost of borrowing any further. Time will definitely tell, but this is a lot of higher for longer talk coming from Canada's central bank. And this isn't talk saying that interest rates are going to be high for 2023 into 2024. Beaudry is talking about a generational shift, a systemic shift into higher interest rates that could last for a very long time. This isn't 1, 2, or 3 years. This is a systemic change. This is talk of a systemic change coming out of our central bank. With that said, whether or not this structural change will actually come, or, as we said, if this is just job owning, if this is just trying to get Canadians to change their behavior, remains to be seen. But we'll obviously continue to have updates out on the central bank, on Canada's inflation rate and its economy on this channel. Click like and subscribe if you want to get those updates. But for now, thanks so much for watching.